He's been a Treasury Secretary in the past. He is an eminent professor. He's somebody who knows what's happening in the US markets and perhaps has a better understanding of what Janet Yellen is going to do. My guest today on ET Now, a very special Professor Larry Summon. Thank you very much for being with us.
Glad to be with you.
I first want to talk to you about something that a lot of people would want to know from you. You travel to India at a time when the whole world is waiting and watching what Janet Yellen is going to do. Is she going to hike interest rates or not? Let me ask you a very specific question. What will be the trigger for a Federal Reserve to hike interest rates?
Oh, I think that Chairman Yellen was pretty clear in saying that the Fed would hike. She expected interest rates as long as it looked like the economy was going to get back to 2% inflation, and as long as there was reasonably strong growth in employment. I think we've seen reasonably strong growth in employment, and I think she feels the evidence is fairly clear that we're going to get back to 2% inflation. So I think that pretty much we've seen the necessary triggers for a rate hike.
So you believe there is going to be a rate hike in December?
That would be my expectation, yes.
And what sort of a...
And that's what the market, that's what, if you look at what the market is saying or what most market participants are saying, that's what they're saying.
Given the fact that she is going to perhaps press the button because there is such built-up of expectation there, and she's also told the Congress that if I'm going to delay a lift-off, it is perhaps going to push the US into another recession. What sort of a trajectory do you think the rate hike is going to take? Is it going to be gradual, very, very minimalistic to begin with?
Barring a substantial lurch in the economy, I'd expect it to be very, very gradual. Some people are saying that there'll be one hike every 2 meetings. I don't know whether that's exactly right, but I would expect very substantial gradualism.
Professor Summers, what do you make of the US economy? And the question that I'm asking you is that, yes, the US economy is beginning to look better, but is it also good at the core, or is it looking rosy only at the surface? Because that is really going to determine how she goes ahead with her rate hikes.
I think there's some aspects. I think the consumer spending is relatively robust, and I think that's most of the economy, and that's a quite favorable thing. I think that there's real issues about the rate of productivity in the American economy, and we may not be growing productivity as rapidly as we did at some points in the past.
So at an economy which is which isn't far above the stall speed that you've called it, how accommodative do you think the US Federal Reserve really can be or should be?
I think it's always a good idea in a very imperfect world to make reversible errors whenever you can, rather than irreversible errors. And I think that tightening prematurely is close to an irreversible error, whereas delaying tightening is a reversible error because one can always tighten in several months.
Inflation is still subdued, and you've rightly said the jobs data is perhaps going to be a big trigger that was reported on Friday. And there is also, you have said there is no denying the fact that the world would not have grown at a healthier pace if the US Fed had hiked interest rates in September. What kind of an impact do you think a Federal Reserve hike is going to have on the rest of the world? I know it's been talked about, I know it's been budgeted for, but every time the decision does happen, do you expect a big reaction in the world?
I wouldn't have any confidence that I could predict that, but my instinct would be that this has been so widely anticipated and so substantially announced that I'd be quite surprised if there was a major adverse reaction.
A lot of people believe that, and this is of course something that you've had past experience with, the US Federal Reserve is obviously going to make monetary policy for the United States. But there is a lot of expectations, and sometimes at an unreal level, that they should take into cognizance the impact on emerging markets.
Well, I think they do. I think they do take it into account, and I think the reason they take it into account is because of what economists call reverberation effects.
Right.
If we do something that affects emerging markets, then weaker emerging market economies hurt ultimately the demand for our exports. And so I would expect us to be attentive to that.
So you would expect the Federal Reserve to be attentive to that, but I still have a question to ask of you, because you have categorically said that while the world's biggest economy is facing challenges, I'd rather be playing the hand the United States is playing in the global economy than any hand that anybody else is playing. What still fuels that confidence? Because at one level, you seem to be suggesting here that the US can go back to being the single engine of growth that it once used to be. Is that a fair assessment of the situation?
I don't think the U.S. can go back to being a single engine because I think ultimately the world needs more propulsion if it's going to move its economy forward. But I think that the U.S.'s prospects of being a reasonably growing economy are better than those of most other countries. Some of that has to do with the fact that we tend to respond relatively quickly to policy problems as we did in 1999. Some of it goes to the fact that we house huge amounts of innovation, particularly in information technology. Some of that goes to a sense of a tremendous resilience of American society and our very substantial advantages. We have the best universities in the world. We have terrific fossil fuel resources. We have a financial ecology that is very good at starting entrepreneurial companies. And so I think all of those features contribute to the strength of the United States.
You have been on court to say that the macroeconomic standpoint, this world is in a very different place versus 2009. What is the difference today?
Well, we don't face the kind of imminent crisis that we faced in 2009, but I think we face a more insidious crisis in some ways of too little desire to spend and too much desire to hoard, which for one person makes the person wealthier because they're not spending.
That's right.
But since my spending is your income, when everybody tries to hoard, there's a tendency for the economy to cycle downwards.
I have a quick question to ask of you on the growth rate per se. Financial markets around the world, including Wall Street, have really galloped since 2009. I mean, Wall Street is up, 150% US markets. That's the kind of rise we've seen. Are financial markets around the world, and US included, a little detached and galloping ahead of what is really the ground economic reality?
That's a judgment every investor is going to have to make for themselves. There's some valuation ratios that certainly look a little high relative to historical standards. On the other hand, with interest rates low by historical standards, one would expect that when interest rates are lower, there would be higher price earnings ratios to companies or higher price to rent, value to rent ratios for real estate.
One last question on the US Federal Reserve and on the US before I move on to China. And that question is really coming in from the whole conspiracy theory that there seems to be some collusion between the Federal Reserve on one hand and White House on the other. Janet Yellen is not pressing the hike button because she wants a Democrat in the House. How would you rubbish that argument if you were to?
Oh, I don't think there's any evidence for that at all. You know, people always talk about that. But if you look at Fed behavior around recessions going back for the last 30 years, maybe it's a little different before that, but certainly going back for the last 30 years, I don't think you can really find any evidence for the political manipulation of monetary policy.
Professor Summers, about 2 to 3 years back, the pain points in the world were really the developed markets, whether it was Europe, whether it was the US. It's beginning to now emerge that it is the emerging markets that are going to be the laggards as far as the global growth is concerned. How worried are you about the emerging market pack per se?
Well, even when emerging markets lag, they can grow pretty fast. If China grew at 5%, it would be very disappointing to China watchers, but it would still be much more rapid growth than any of the industrial countries can reasonably anticipate. But I am concerned. I think China faces a lot of challenges, from non-performing loans to managing rural migration into the city, from huge environmental issues to difficult questions of remaining competitive as wage rates rise, from balancing the desire for balancing political and economic autonomy in a way that keeps social discipline but also takes advantage of all the opportunities for creativity. I think these are very, very large challenges China faces.
So while you're talking about China, it's only fair to ask you, are you a little less worried about China than you were 2 months back?
I think you have to be a little bit less, just because financial market things have seemed to come under control. But I still have a concern that China is not going to grow is not likely to grow as rapidly in the not too distant future as it has in the not too distant past.
You know, it's important to also touch upon the point that there was a pre-financial equilibrium where China was the global supplier, where China was investing big time into US treasuries. A lot of that has changed. How is the new work, if I may say, business model going to evolve, and how is this going to impact the world really?
We'll have to see. I think it's still in early information.
So you don't believe the world should lose a lot of sleep about China as it is right now?
I think there are a lot of issues with respect to China. Many of them are in the security sphere. Some of them are in the economic sphere. Certainly China has seemed to have been associated with some troubling things in the cyber dimension, for example.
That's right. Before I move on to India, and because we are at China, I have one final question on emerging markets. You did say that we've seen this coming for a long time, the US Federal Reserve decision. But do you believe emerging markets should gear up for a big outflow of funds when Janet Yellen does go ahead and hike rates? Because that is really the big fear as far as that impact is concerned.
I think it's unlikely. I think the fact that it's been so widely anticipated means that insofar as there was a desire to move funds out, I suspect it's already happened.
Let's move on to India, and if I may ask you a very audacious question here, there is an IMF report and there's a World Bank report that seems to suggest that India is the bright spot in an otherwise troubled neighborhood. Are we being a little too ambitious? Are we being a little too optimistic there?
No, I think it's probably reflecting reality in terms of how much trouble there is in your neighborhood and how much economic difficulty there is in your neighborhood. No, I think India is standing out more as a bright spot than I think it ever has economically.
And what is contributing to that bright spot?
Much of it is the problems that other people are having. Secondarily, it is the rhetorical commitment, at least, of the new government to address the issues in public employment, for example.
The pace of economic reforms in India, and there was this irrational euphoria that Mr. Modi, when he came to power, is going to be, is going to solve all problems. The pace of economic reforms in India has considerably slowed down. There is a lot of politics at play, and you'll understand this because it happens back home between the Republicans and the Democrats as well. Do you believe at one level there is a correction of expectation, and there should be a correction of expectation according to you?
I'm just not sure. I think there's a lot India can do to accelerate its growth, and I'd rather see the emphasis be on accelerating the growth than on lowering the sights.
Do investors and do stakeholders in the US worry about the kind of political logjam there is in India on most reforms?
I think that kind of thing and political logjam is probably an important contributor to the fact that India relates very, very low whenever there's a doing business survey.
That's right.
Much lower than a country of its sophistication should.
And where does the onus of correcting that perception lie? On the government or on the opposition? Because you've been a part of government, so you would know the answers.
I think some combination of all of the above. I think government could be persuaded that it isn't a good idea to advertise these things, but I think it takes a broad-gauged response.
So while we are talking about India, let's refer to your old good friend Raghuram Rajan. He is the central bank chief here. Your older friends, Stephen Roche and Joseph Stiglitz, have said that inflation targeting is something that doesn't really solve a lot of purpose. The West has done it, has gotten out of it. India is beginning to do that now. You're not a big fan of that, are you?
I think...
And can central banks have a single-minded focus, so to say?
I'm a bit skeptical of reducing everything to one number and then targeting... And then targeting that number. I don't think that's usually a good way to do those things. But I have not read the Roche and Stiglitz papers, which I will now go and do.
I also want to speak to you about the raging debate in India around interest rates. There is a lobby that believes that Governor Rajan should pull all stops and go ahead and reduce rates. And there's another lobby that believes that he has to be very cautious given that there is a US federal rate hike right around the corner. Inflationary concerns haven't really ceased to exist. Which side of the two debates would you throw your weight behind?
I'm not sure that I know the two positions and have studied the decisions long enough to provide an answer. I certainly hope that questions about achieving adequate growth will be an important factor in the decision making.
Professor Summers, you've been a part of government, and so you obviously know the relationship between fiscal austerity on one hand and fiscal expansion on the other. In India, we are beginning to see that debate re-emerge. Should the government throw its weight behind fiscal austerity, contain the deficit, or should it actually let loose and go ahead there and spend a lot more, even if it were to breach some of its targets? Do you think that's a wise thing to do?
I tend to be more enthusiastic on the spending side.
And why do you say so?
Because I think in this environment there are real limits to what monetary policy is able to do, and therefore use of fiscal policy may even pay for itself by a larger economy, and an economy that doesn't have so large a deferred maintenance bill has a more attractive fiscal path.
Before I close this debate, I have to ask you a question, and I want you to share lessons here. You've been a Treasury Secretary, you had an equation with Alan Greenspan as the Fed chair. What are the lessons that emerging markets can learn from the relationship that US Central Bank and the US Treasury really shares?
I think respectful, mutual respect, a serious willingness to look at data and sometimes change your mind in the face of evidence, and a general theory that politicians should set ends and technocrats should set means is something that I think would serve countries well.
Is it too utopian to imagine that central banks and treasury secretaries can get along, or for that matter finance ministers and RBI governors can be on the same page?
No, I don't think it's, no, but I think that's the different thing than one of them giving the other orders or there being completely joint decision making. I think for a variety of reasons, I don't think completely joint decision making is healthy, but I think they can be respected interlocutors of each other.
So two quick last questions. One, of course, is on the US presidential elections right around the corner. You would believe a Democrat is going to serve the purpose of the United States better in office. How is the US presidential election panning out back home? Hillary Clinton has high chances, you believe? You've worked with one Clinton and now we're talking about the other.
I think there are places where one can place bets, and so there's a kind of active market, and that active market, I think, is suggesting that Mrs. Clinton has a very, very high chance of being nominated, and that if she is nominated, she has a strong chance of becoming president.
You worked with Bill Clinton in the past. You were his Treasury Secretary. How different are the two Clintons?
I think they have in common a serious commitment to the United States. They have in common a deep interest in being a policy wonk and actually understanding what happens in policy. They have in common a commitment to middle-class people and to growing a rising middle class is the key to any healthy society. So I think on a number of questions of broad values orientation, they're very well aligned.
So as the US presidential elections progress, and we've seen them in the past, there is political rhetoric that gathers pace. People start talking against offshoring. People start comparing Bengaluru to Buffalo. Do you think that debate is settled for good, or will we see re-emergence of that debate really?
Nothing ever goes away forever.
Thank you very much, Professor Summers, for talking to us.
Bye-bye.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.